All right, let's get right into it. Welcome to this explainer. Today we're putting on our hardcore fundamental equity analyst hats, and we're going to execute a clinical, uncompromising due diligence breakdown of IDEXX Laboratories, ticker symbol IDEXX. We are strictly relying on their Q1 2026 filings, earnings call transcripts, and Trephis financial data to see what's really going on under the hood here. Our goal is simple: extract the exact metrics, tune out the market noise, and figure out if this company's true intrinsic characteristics actually justify its current market narrative. So let's start with the absolute elephant in the room: 39.2 times. According to the latest Trephis data, that is IDEXX's forward price-to-earnings multiple. Look, by literally any traditional valuation standard, this stock is expensive. You're paying a massive premium for future earnings. If you're a classic value investor, seeing a multiple like this usually has you running for the hills, right? But before we just write the stock off as wildly overvalued, we really need to look at the other side of the coin. Because what fundamentally challenges that sky-high valuation is a completely staggering 99% trailing 12-month net income to free cash flow conversion rate. We pulled that directly from the Q1 2026 earnings call. Just let that sink in for a second. For every single dollar of net income they report on the books, 99 cents ends up as cold, hard cash in the bank. That is elite operational quality. And honestly, this is the ultimate curiosity gap for our analysis today. How exactly do we reconcile a super steep 39.2 times P/E premium with a basically perfect cash flow conversion engine? So here's our roadmap for the explainer. We've got 1. The curiosity gap, 2. Valuation and fundamentals, 3. Margin health, 4. Macro and operations, 5. Risk factors, and finally, 6. The margin of safety. Okay, moving into section 1, valuation and fundamental frameworks. If we look at this through a Peter Lynch lens, where exactly does IDEXX sit? Are they a slow grower, a stalwart, or a fast grower? Well, the Q1 2026 earnings release explicitly reports a comparable EPS growth of 15%. Plus, the comprehensive financial analysis report points out that the company is fully positioned to maintain mid-teens earnings growth moving forward. So that puts IDEXX right on the borderline between a highly dependable stalwart and a true fast grower. Basically, they're compounding at a really aggressive yet surprisingly stable double-digit rate. Now, for all you modelers out there building a discounted cash flow or DCF model, this perfectly highlights the exact inputs you need sourced straight from the Q1 2026 earnings snapshot. We're seeing free cash flow generation of $234.26 million for the quarter, and that's derived from $266.25 million in operating cash flow. Management also firmly guided a projected 2026 CapEx of $180 million, targeting a full-year free cash flow conversion between 85% and 95%. These are exactly the kind of highly predictable, capital-light cash flows that DCF models just absolutely drool over. Next up, let's pivot to the Oracle of Omaha. Running IDEXX through the Warren Buffett tenets to check for a durable competitive advantage, the Trephis data reveals some absolute monster profitability metrics. We are talking about a return on equity of 72.9%, a return on invested capital of 43.5%, and a return on assets of 33.2%. And look at their capital allocation strategy. The dividend yield is 0%. Why? Because management has chosen to plow a massive $2.5 billion into buybacks over the last 3 years. They are aggressively reinvesting in themselves. And you can see exactly how they're executing this strategy if you look at the timeline from their Q1 2026 10Q filing. In January, they bought 0 shares, but in February and March, they completely stepped on the gas, repurchasing a combined total of over 600,000 shares. All in all, they spent $360.8 million in the open market during just the first quarter, at an average cost of roughly $614 per share. That aggressive buyback directly supported a 2.1% reduction in diluted shares outstanding. But let's flip it and look at this through the highly defensive lens of Benjamin Graham. To calculate a Graham number, you need book value and EPS. The Q1 26 EPS sits at $3.47, but Trephis data shows the price-to-book ratio is 27.59 times, and the price-to-tangible book is an eye-watering 41.32 times. So here's the crucial takeaway. A classic asset-based Graham valuation just kind of falls apart here. The market is clearly placing a massive premium on IDEXX's intangible assets, their IP, and those sticky recurring revenue streams, rather than their physical book value. All right, Section 2, Corporate Margin Health and Financials.
Honestly, this margin waterfall, pulling data from Trefis and Q1 2026 earnings, is just a thing of beauty. They start with a really robust gross margin of 62.1%. After you strip out operating expenses, they're still holding on to an operating margin of 31.8%. And finally, that all distills down to a net profit margin of 24.6%. For a company dealing in physical equipment and diagnostics, generating basically a quarter of pure profit for every dollar in sales is exceptional. It points to immense pricing power.
But here's what's actually super interesting about the underlying mechanics of that margin. The comprehensive financial analysis report highlights that operating margin expanded by 100 basis points on a comparable basis. But it wasn't just a straight, easy line up. This expansion happened despite them taking a current $5 million loss on an equity investment, mainly because they are lapping discrete litigation expenses from the previous year. What that tells us is that even with some minor investment headwinds dragging them down, their core operational profitability is still expanding.
Checking out the solvency side, the Trefis data shows a debt-to-equity ratio of 0.71 and a current ratio of 1.12. Digging deeper into the balance sheet analysis, we see they've drawn $530 million on a $1.25 billion credit facility. That translates to a gross leverage of just 0.6 times and a net leverage of 0.5 times. In plain English, this balance sheet is rock solid. They've plenty of liquidity to weather economic storms or fund future M&A without getting choked out by heavy interest payments.
Which brings us to Section 3, Macro Impact and Business Operations.
So the real engine behind their recurring revenue moat, it's all about placing their Catalyst diagnostic instruments right into veterinary clinics. The Q1 earnings transcript details an incredibly aggressive global expansion strategy. They executed over 1,350 new and competitive Catalyst placements globally in just one quarter. 360 of those were in North America, but a whopping 990 were international. This massive global push drove a 12% overall expansion of their install base, which essentially locks in years of high-margin consumable sales down the road.
But going global means you're stepping into macro crosshairs, specifically foreign exchange risk, and the Q1 2026 earnings call hit this head-on. Management warned that just a 1% strengthening of the US dollar would slash revenue by roughly $12 million and eat into EPS by 4 cents for the rest of the year. When you're operating on a global scale, currency fluctuations are a constant, annoying headwind that can easily obscure your real operational growth.
All right, let's look at the flip side. Section 4, Fundamental Risk Factors.
We did some serious digging into the 10Q filing to find where the hidden risks might be buried on the balance sheet, and two things really stood out: contract assets and AOCI. Contract assets represent earned revenue for instrument placements that hasn't actually been billed yet, so that holds real collection risk. If a clinic defaults, poof, that revenue vanishes. Then there's accumulated other comprehensive income, or AOCI. Think of it as a balance sheet reservoir for unrealized losses and currency translation hits. It doesn't hit current profit, sure, but it alters total equity, and it's a crucial leading indicator of global macro stress that analysts absolutely need to watch.
But here is the real cyclicality threat, and it comes straight from the clinic floor. According to the Motley Fool's earnings transcript, U.S. clinical visits are expected to decline by 1.5% this year, thanks to ongoing pressure in wellness and discretionary services. This is a massively vital metric. IDEXX makes its real money on diagnostic testing volume. If consumers are feeling the macroeconomic pinch and fewer pets are walking through those clinic doors, that puts a direct ceiling on IDEXX's core recurring revenue, period.
And on top of that, maintaining this massive competitive moat, it's getting pricey. The Q1 earnings snapshot showed that comparable operating expenses spiked 11%. Now, this was driven by very necessary, aggressive investments in global commercial and innovation capabilities. But while they absolutely have to spend this money to fund R&D and fight off intense competition and customer consolidation, rising friction in operating expenses is something you have to monitor super closely when top-line clinic volume is already feeling a little depressed. Let's bring it all together. Section 5. The margin of safety. Okay, so what is the ultimate fundamental tension here? On the pro side, IDEXX boasts elite operational quality, a 99% free cash flow conversion, and a 33.2% return on assets is frankly incredible. Their recurring revenue model does heavily insulate them from certain macro shocks, which keeps their mid-teens EPS growth target completely intact. But On the con side, they are facing very real headwinds from a strong dollar and declining U.S. clinical visits. And the kicker, all of this is currently priced at a perfectly pristine, highly expensive 39.2 times forward earnings multiple. Which leaves us with one final massive question. Does a near-perfect 99% free cash flow conversion rate actually justify paying a 39.2 times PE multiple today, especially when the underlying volume of U.S. clinical visits is shrinking? Are you paying up for a pristine, historically dominant business model? Or are you overpaying for future growth that's about to hit a wall of macro friction? That is exactly the question you have to answer before allocating a single dollar of your capital here. Thanks for joining me for this deep dive in the Explainer. Keep analyzing, and I'll catch you next time.